celebrations mark the beginning of 2015. This is also the year when interest rates are likely to go up in the US after 6 years in zero territory. The consensus is for rates to start rising in June. And market watchers warn, brace for volatility as the US central bank raises interest rates.
Labour markets are improving very, very quickly. Wages are beginning to go up, and the Fed is already a long way behind the curve on policy tightening. So I think there's the risk that volatility increases, and you certainly hit a period of a soft patch for risk assets in anticipation of the Fed rate hike in the middle of the year.
But even as US interest rates go up, monetary policy remains easy in Japan and Europe. The Bank of Japan expanded asset purchases in October. And the European Central Bank remains ready to take more measures, like buying sovereign bonds to support the economy. With liquidity still abundant in the global financial system and the US economy picking up, the outlook for Asian markets remains positive. The MSCI Asia ex-Japan index was up more than 2% last year. The index has been rising since it fell almost 20% in 2011.
What Asia had going for it this year so far has been lots of liquidity. Interest rates remain low, money is cheap. And secondly, there's a lot of hope in Asia. Investors have seen what the stock market of Philippines can achieve given a new government. And they have sort of extrapolated that to what India can achieve, to what Indonesia can achieve, and even to some extent what the military government in Thailand can achieve.
But wealth management firm Pictet says some markets in Asia are now looking fairly valued.
The Southeast Asian markets have had a bit more of fair valuation today because they've done very well over the last 3 years and they've run a little bit ahead of earnings growth.
That doesn't mean investors should avoid Southeast Asian equities altogether.
From an economic perspective, nothing much has changed even in Southeast Asia. So GDP growth rate, be it in the Philippines, be it in Indonesia, be it in Malaysia, Thailand, Singapore, is going to be more or less where they've been, and they're on trajectory. So which means the regular economic sensitive sectors, consumption, maybe some of the more non-directly related things like healthcare, transportation, these are all places that you want to be in this part of the world. Commodities is possibly the obvious one to directly avoid. Maybe some of the rate sensitives also you need to be careful about.
Indonesia and the Philippines were the stars of the region, closing out 2014 with 22% gains. Thailand followed closely behind.
In the last 4 or 5 years, financial markets have been desperately looking for any good economic story to invest in. And so the equity markets already look quite richly priced to us. So our equity analysts say, sure, you can find a lot of interesting stocks, dynamic companies, but they're trading at very high multiples.
In 2015, India is one market that bears watching. Pictet expects economic growth there to hit as high as 7.5% over the next 3 years.
There are many beneficiaries of this growth, and it's not priced in. So which means India can constantly be on an earnings upgrade or an earnings cycle which is positive in its momentum. 2, rates have been higher in India than most other places thanks to inflation. And as inflation is getting aided both by lower energy prices as well as food prices are being tackled and supply chain is being tackled, I think you can see a structural decline in inflation going forward. If that were to happen, that can really be a big event for India's growth and valuations.
Some feel the game changer for India is the election of Narendra Modi.
We've seen a lot of companies express optimism. This is reforms, it's little things like clearing the backlog of projects. I think estimated more than 100 billion worth of projects has been cleared since the new government has taken over.
Others think too much hope has been placed on the Modi government.
Realistically, it's very hard for one guy to have a big impact on the overall economic performance.
And the biggest turnaround story in Asia has to be China. The Shanghai Composite closed out the year more than 50% higher. The index was one of the world's worst performers in 2013, with a loss of 6.8%. But China's economy is slowing. To stimulate growth, the central bank cut interest rates in November, its first cut in more than 2 years. It has also eased some lending restrictions. Further easing will be a catalyst for Chinese equities.
Two main points. One is the HK Shanghai Connect that took off, I think, in November. The second was obviously the very recent Bank of PBOC interest rate cut, and that really lit the fire. So now expectations are very high that after this first cut, there will be more and more to come.
The slowdown in the economy is also nothing to worry about, according to Pictet. In fact, China's growth could slow further to 6% or lower between 2020 and 2025.
It's perfectly okay for China to slow. By that time, it was almost likely to be the largest economy, and you don't need the largest economy in the world to grow faster than that, okay? And for various other reasons. I mean, it's fairly developed in so many other infrastructure-related things. All the capital-intensive things have been done, okay? So it's more of the service orientation and maybe a realignment within China as to where the growth has to come from.
One theme that Pictet likes is high dividend plays in Asia. Pictet says this is not a theme that you can play globally. As for Nikko Asset Management, healthcare, insurance, the environment and tourism are the sectors that it favours.